Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you today, Martin?
I'm all right. I tell you what, things don't get quieter. Things get ever more crazy.
They certainly do. It's been a crazy month in the crypto world as well. I know we're going to touch on that today, but any opening thoughts before we get into the slides?
Well, I'm fascinated by the way that the markets have been oscillating between enthusiasm and doom and gloom and back and forwards, right? And it shows me, I think, that almost nobody knows what's going to happen and nobody knows precisely where things are going to end up. So the level of uncertainty, both at a household level and, at a commercial level and I guess internationally, uh, I think it's probably never higher than it's been. So I think the uncertainty principle is probably what I'll be focusing on today. That nobody knows.
Yeah, absolutely. And that probably comes with your first slide here, as we often talk about the RBA have possibly been one of the worst in terms of their forecasting. I mean, all central banks around the world have been, but they really went out there and gave some firm dates, and they're now coming out and apologising.
Well, it's interesting because Phil Lowe gave evidence to the Senate estimates a couple of days ago. And in fact, the senators did quite a good job of actually asking some tough questions. I've actually been posting some of those on my YouTube channel because it's quite interesting just listening to the interplay. But yeah, Lowe sort of apologized but didn't apologize. I'm certainly sorry if people listened to what we said and then acted on that and now regret what they've done. So look, it's not really a sorry, right? And in fact, when you listen to Lowe, he said, well, we were thinking the economy was going to crash. We sort of took rates really low, et cetera, et cetera. But the truth is, of course, they kept rates ultra low, despite the fact that it was clear quite soon that things weren't going to be quite as bad, and then left them there. But if you go back further, they made the wrong decisions previously because they dropped rates much, below where they should be. So the real message that came out of this Senate estimates conversation is the RBA has no idea about what real households and real businesses are feeling and experiencing at the moment. All they're worried about is this sort of this big financial edifice that they've built. And like other central banks around the world, lack of credibility. And frankly, nothing that Lowe said, I think, 2 days ago restored any confidence in him or the RBA. They're still sort of, faffing around. And so if people want to try and get at understand what's really going on, it's worth listening to some of those estimate hearings because they did actually try to hold him account. And in fact, Senator Rennick asked him specifically about who holds you accountable. And the answer was not very positive.
Yeah, well, as always, the links to Martin's channels down below, guys, if you want to check out some of those videos when he posts them. But I think, again, just to give people some of this context, it's one thing for the first homeowner to get into the market and be told that we're not going to raise rates for a couple of years. But it's also the business confidence, and that filters through all these, from a startup to these large businesses to issuing debt to even, the crypto markets. When there's not a lot of money around and things are going bad and people are hesitant, you don't get that new investment, and that all trickles through to the economy and growth and then unemployment, and it's these knock-on effects, and that's why the RBA have so much, or all central banks have got so much importance on every little word they say in these statements these days, because it has become a confidence game, as we've touched on so often.
Yeah, and it's worth saying, that the RBA was clearly working very closely with the government. So how objective and independent were they? And there's a review currently running with regard to RBA decision making and the structure of the RBA. I think there'll be some changes. It's probably good, but the damage has been done, frankly. And we're going to be struggling now through high interest rates for a long period of time. And many people took out those mortgages. 2 or 3 years of low rates were promised, and well, now they're up against it.
Yes. All right, so the RBA is worried about the falling consumption.
So this is really interesting. So this is an old chart, but it's very important because what they said was, where is the risk of consumption eroding? And the answer is, it's to do with the wealth effect. So, whilst there's an impact from lower or higher unemployment and lower or higher or lower investment returns, it's the wealth effect. In other words, when people feel as though they're affluent, they're going to spend more, and that's economically positive. But the reverse is also true. If in fact they see home prices fall and wages not rise, the wealth effect works negative and quite quickly. And that is, I think, what we are seeing now, with regard to significant pressure. So that's why the Reserve Bank is really concerned, I think, about where house prices may be going and the feedback loop negatively on the broader economy, and we'll come on to later. That translates into lower house prices, lower levels of confidence, lower spending, and all of those things.
Yeah, and I think that slide really shows something we touched on, I believe, in last month's episode, in terms of the scenario that exists where they might do everything they can to relaunch the QEs of the world to prop up stock markets, simply because it's better to have the stock market still in a bubble, even if the real economy is failing and cracking, because this wealth effect is so important, and probably more so in Australia than global markets where we have so much in super.
Well, that's right. A lot in super, and of course, a lot in equity in houses, because house prices ran through the roof, literally.
Yes. All right. So higher for longer. I mean, a few people are starting to talk about maybe there's only one more hike coming, and that's going to be enough to break things. But the official cash rate's still pricing in, say, 4 more 25 basis point hikes.
Yeah, so the ASX 30, this is the sort of full view of the market. It's actually come down a bit. So I think last month they were above 4% out in 2024. They've come down a bit. But most of the economists, among major bank economists, are talking more rate rises to 3.85 as a sort of a target hike. So in other words, the rate hiking cycle, although we're doing on 25 basis points at the moment, is not over. And the markets are saying it's going to go higher and it's going to stay high. So rates are going higher and they're going to stay there for longer. That is a very important message, because remember, it takes 3 months or so for those rate rises to propagate through. And in fact, it takes about 18 months for the full effect of those earlier rate rises to hit the economy. So in other words, the RBA is flying blind. One reason why they're probably going slow rather than not. But you've got to expect the rates will be higher for longer.
Yeah, and are you in agreement with this, Martin? I mean, I'd like to go out and say that I don't think that we're going to see it get to where they're pricing in, and I also think we'll start to see cuts easily within the next 12 months. So is that a contrarian opinion, or do you think that it's going to be higher for longer?
Well, it goes inflation, of course, is what the RBA is chasing. And so the question is, where is inflation going to be? Now, we're going to get data later out today. I couldn't get it in time for the recording of this show, showing the latest CPI number. The RBA is saying 8% inflation, coming down to about 4% the other next year, and then back within band the year after. They can't really start to cut rates unless they see significant reductions in inflation. And whilst there are some arguments as to why the base effect will mean that some of those big raises will drop out in a little while, so we should see inflation come down, most people would say inflation is unlikely to come back within target bands. And if the RBA is true to its normal mantra that inflation is the critical battle, then it's unlikely. But there is a broader question here. If, in fact, the financial system starts getting the difficulty, if, in fact, banks starting to find that the default rates on mortgages rise, that changes the whole scenario, and maybe then the RBA moves the conversation from inflation to financial stability again. If they do that, rates could be cut significantly and quicker. So that's the scenario range. Like I said, uncertainty everywhere.
Yeah, that's what I guess I'm starting to see. If particularly Europe and European banks are getting hit hard, it's those sort of caveats that are going to affect global markets. And if the US is forced to ease to save other banks and that kind of thing, it's just going to be Australia following suit. So that's kind of, I think the cracks are going to start appearing a lot quicker than what they're pricing at the moment, from how we've had the most sudden rise in rates ever.
Yeah, and look, cracks may well come from the bond market again, or it might come from somewhere else, or, the spillover from crypto. There's lots of uncertainty out there. And I don't think that anybody can accurately predict where this is going to go. That's why I always talk about scenarios. There's scenarios where rates go higher and stay higher. There's a scenario where rates go high and then come back down. And there's a scenario where rates get cut quickly because of those global uncertainties. Any one of those scenarios is a viable scenario currently, which means it's very hard to plan anything.
Yes, exactly. All right, so we've seen some pretty big falls, particularly in Sydney and Melbourne, continue.
Yeah, so this is the latest from Christopher Joy. So, you're seeing the slides continue. And, of course, interestingly, it's Brisbane and the Gold Coast where the falls are most significant. They ran up significantly through the last couple of years, now falling again, particularly houses. Most states and territories are seeing some adjustments. And the question, of course, is now how far down. So ANZ came out and said 18 to 20% total falls. Christopher Joy is saying 20 to 25, maybe even 30%, I think. So there are lots of different opinions there. Again, the uncertainty principle is nobody knows, right? But certainly the chances of seeing any capital growth in property in the next couple of years is, I would say, close to zero as you can get. So in other words, it's now going to be, is it sideways? Is it down? And how far down?
Okay, so rents are still ticking higher as well?
Yeah, interesting data on rents that I saw came out yesterday, I think it was. And the interesting observation, if you look at Sydney and Melbourne, rents are now back to where they were in 2017, 2018. So, they've come back up again. In other places, in regional areas, they're quite a lot higher. But there's an argument that says rents are more linked to wages than anything else. So if wages aren't growing, there's going to be a ceiling on how high rents can go. First point. Second point is this ABS is reporting rents in the CPI at maybe a couple of percent. New rents are closer to 20%. So there's a lot of CPI overhang yet to come into the official numbers because there's always a lag, which would suggest to me that these rising rents, as well as putting pressures on households, are also going to put pressure on inflation as well.
Yeah, I mean, I'm not sure I would have said that wages in Greater Hobart area would have been growing faster than Melbourne and Sydney, but I haven't seen that data. Have you?
So there was some variations because, of course, you had a lot more people off work in Sydney and Melbourne over the last couple of years because of COVID. You were somewhat protected down there in Tassie. But you've got to actually go, if you want to look at wages growth, you've got to break it down by individual groups and individual occupations. There are some occupations doing really well. For example, people working in the construction industry, if you're a tradie, you can pretty much ask what you want and get paid, right? Whereas if you work in healthcare in the public sector, a lot of public sector wages are going backwards in real terms. Plus, there's almost no growth. So it depends on the mix.
Yeah. All right, Aussie apartments. Now, this has been a hot topic for a number of years, the amount of Chinese investment. And by some metrics, it's not as high as the media makes it out to be. There's other countries that invest just as much in Australian businesses and property as China does, but they do make up a significant amount either way.
Yeah, so what's important is that not all investors are from China, but there was a significant tranche of apartment purchases from China over recent years. And what this article from the Australian is saying is that that's unwinding. So we're starting to see Chinese buyers now putting their properties on the market and getting out. Why? Well, for two reasons. One is there are domestic issues back in China. But secondly, if you look at the performance of a lot of these property areas, particularly apartments, and I always use North Ryde as an example because that just happens to be somewhere that I know quite well and I've studied it for a long time. Apartment prices in North Ryde were higher in 2017 than they are today. And the returns, therefore, are negative. And in fact, from a rental perspective, not good. So what we're starting to see now are some of these coming on the market. And in fact, that's one of the reasons why property listings are quite a lot higher. So there's a lot going on here. And I agree with you that this is not the only story with regard to property, but in some suburbs, particularly in the high-rise areas, there's a lot of damage still to come through.
Yeah. Not too much to say on consumer confidence, a little bit of a bounce, but still low.
A little bounce, you see, this week, and I reckon that's the Black Friday sales, we're still going to sell, we're still going to spend whatever, right? We but look, the confidence levels are still way down. And this is the big contradiction. So households are still, on one hand, spending quite big, although a lot of that is more because you're having to spend more money just to get the same goods as last time because of high inflation. But the confidence levels are really low. And that's the same in a lot of Western countries as well. So if you look in the US, if you look in the UK or in New Zealand. Now, you could argue, I think, that confidence is a leading indicator, sales is a lagging indicator, which would suggest to me that if the confidence measures are roughly right, then we're going to see sales dropping on quite quickly ahead, which is going to put more negative impact on the momentum with regard to GDP growth.
Yep. Here's a slide on the earnings and wages.
Yeah, so this is just from the latest statement of monetary policy that highlighted the fact that the RBA is saying there's going to be some wages growth, but it's not going to be sufficient to offset the higher levels of inflation for at least a couple of years. In other words, no real wages growth at all. And in fact, interestingly, going back to that Senate discussion, there was a lot of discussion about nominal wages growth rather than real wages growth. Now, of course, real wages growth means after inflation. So the RBA is only targeting nominal wages growth, which is very interesting. And what it means is that in real terms, many households have continued to go backwards. And in fact, if you trace the trends, it was 2011 and 2012 when many households last got a wage rise, which actually improved their living standards. Since then, most households have gone backwards, unless you are in the more affluent segment where you're getting paid a lot more and those wages and bonuses are much higher. But many people have seen no growth in real income in many years, and now the RBA is saying expect it for the next couple of years. And of course, recently Lowe said we don't want to have too high wage inflation because if we do, that's going to stoke inflation again. And he was arguing for people being very cautious about making wage claims. In other words, never mind what the 1% is doing. Most people are going to be squeezed and squeezed even more by this.
Yeah, what we've spoken about on both our channels for a long time, it's about being behind the eight ball, and it's very hard to catch up, particularly if it becomes just a compounding effect, particularly at these higher inflation rates. You're just in real terms falling further and further behind.
Absolutely. And look, the inflation rates around food, for example, are very, very high, which means that people are having to scale back or just buy less good quality, or and in my surveys I put an extra question in now asking specifically about how people are handling this. And it's interesting, some people are actually spending less, some people are not going out anymore, they're eating at home, some people are skipping meals now. That's really concerning.
Yeah. All right, so mortgage stress continues to rise pretty steeply.
So this is the Roy Morgan stress series, not my own. And of course, Roy Morgan defines stress more like the banks would look at it rather than mine, which is a cash flow measure. But they've said now more than 1 million households are actually now experiencing mortgage stress. And you can see it's upticked quite significantly. That's, of course, following the interest rate rises. Remember, I said lags of 2 to 3 months behind. So we're going to see more stress later. And this trajectory higher, I think, is pretty concerning. And so, it's a validation of my own modelling and what I was seeing. Now Roy Morgan's come out with it too.
Yep. Black Friday, so electronic sales have fallen a lot. And is this in, again, nominal terms, if electronics have gotten meaningfully cheaper?
So this is basically indexized but not inflation adjusted, as I understand it. So it shows you that it was quite a good Black Friday, but electronics particularly were significantly down. And what ANZ, and this is based on their flow through of data that they've got, it said that it was a reasonably positive one, but not probably as strong as many people were expecting. So I'll be interested to see how this translates then into spending up to Christmas. And again, in my surveys and other surveys too are suggesting that people will be hunkering down and spending less. And interestingly, a lot of the deals that were bought on Black Friday were those deep discounted ones. There was a lot of stuff that was not really deeply discounted, but people still bought it anyway. So it's quite interesting what's going on. I think the next 2 or 3 months, retail sales, worth a watch.
Yeah. So New Zealand continued to be more aggressive than Australia in terms of their hikes.
Yeah, so New Zealand, again, lifted by 75 basis points, and now they're saying the terminal rate could well be over 5%. Some of the markets are saying 5.5%. And basically, Adrian Orr said, we've got to do it, we've got to crush inflation. So it's the same mantra as Phil Lowe, but he's sort of following through more than Lowe is in terms of actually lifting those rates. They did say that unemployment was still really low and that households still had some buffers, but then did concede that not all households were in that boat. So they're expecting home prices to fall further. They're expecting more households to get into difficulty. Of course, the property market in New Zealand is coming way off the boil. But interestingly, some of the price falls in Australia are more significant. They're dropping faster than in even New Zealand, despite the fact that New Zealand has actually done more with regard to rate rises. So interesting to see how that plays out. I think that we're going to see the next few months being very significantly concerning because the Reserve Bank of New Zealand is saying we've got to put rates up again and again. So we'll see that cycle continuing. That's going to put more pressure. And they are talking about this fundamental idea of driving down demand. We need to stop people spending. We need to stop people borrowing as much, driving down demand to get to demand and supply in equilibrium, right? Interesting that, of course, the supply side is maybe political and government rather than the demand side, which is monetary policy. It shows you how the monetary policy and government policy stuff is sort of connected, but nobody really wants to join the dots. There's political weight there to try and not do too much to sort of mess around, with stuff that they could control. So they leave it all to the heavy lifting of the Reserve Bank. And the Reserve Bank here and in New Zealand, they keep saying the government's got to do other things too. There's got to be other policies done to bring this back into equilibrium. Otherwise, they'll have to put rates up higher, and that means that effectively mortgage rates and everything else will be higher too.
So, Martin, any thoughts about why New Zealand hasn't fallen as quickly as Australia? I mean, don't they have similar debt to GDP and household debt to GDP and those sort of metrics, similar in terms of the lockdowns and mandates and that kind of thing? So any reason why you think they have had more buffer in savings, or what's the difference there?
So there was a bit more buffer in savings. They also have more longer-term fixed-rate mortgages in the system, I think.
Okay.
And there were also some earlier signs of people having to borrow less because the Reserve Bank in New Zealand was given an accountability for house prices earlier on, and they brought in some extra rules with regards to how much you could borrow for a given level of income and those sorts of things. So there were more controls in the system in New Zealand before the price falls and the interest rate rise started. So I think they've probably got a better set of controls already in, which mean that people were less leveraged than in Australia. In Australia, of course, if you got a Polish, you could get a mortgage of 6, 7, 8, 9 times your income. And even now, banks are still being very generous. And by the way, if you refinance from one bank to another bank, some banks are not even doing a new evaluation. They're taking the evaluation that was done previously and say, well, if you've got the loan there, you can have it here, of course. So I think we're going to see this play out. And I probably think we're going to see worse outcomes in Australia and New Zealand because New Zealand was more across the issue than the Australian entities were.
Super important point in answering that question, Martin. The way you put it like that, this is why we have these safety measures in place, because when we do get inflation, we can go harder at it without crushing. And where Australia might be stuck in that sort of in-between limbo, and it's harder to fix the problem because of the problem you've already caused, and it's all kicking the can down the road for so long that it ends up in this spot where you aren't able to fix things with those same levers that you have.
And look, we could still be in a deflationary spiral at the end of the day, or it could be an inflationary spiral. It goes back to nobody knows, it could go one of two ways. But the settings that we've had in Australia over the last 2 or 3 years have been wrong. I was arguing, in fact, that the settings in Australia have been wrong for longer than that. We've had massive policy failure, and that's both central bank policy failure and also government policy failure. But nobody wants to confront it. Everybody wants to sort of sidle around it and say, she'll be right. I think in New Zealand, they actually are doing more of the right things to get this under control. So I think they'll come out of it quicker. And I suspect that the damage ultimately will be less than here in Australia because we're muddling along rather than actually dealing with the things that we should be doing. And, just to give you some ideas of muddling along, look at Spain, look on the next chart, right? Spain has said they're going to help mortgage borrowers as rates surge. About 1 million Spaniards are going to get help from the government to pay their mortgages. Now, I'm just waiting for a similar initiative here in Australia, right? Not only do we have shared equity schemes and we have stamp duty changes and, all the levers, they're still trying to pull them to try and save the property market and save the banking system. And it's not necessarily conducive to dealing with the inflationary issue that we've got at the base of the problem.
Yeah, and I think letting people dip into their super is probably one of the things that's definitely coming now as well in Australia. Any means they can.
We did it a couple of years ago with through COVID. So why not again? And we're going to see a lot more of that. So they're going to do all the what I call the natural and natural acts. So they're unnatural, but they're natural because of course that's what central banks and what governments do to try and prop up the property sector. And remember here that we've got 65% or thereabouts of all lending to property. Right, and if you add then the construction sector over the top, it's nearer 70%. So, we have a massive property leverage problem in Australia. And the banking system is highly exposed to it, which is going back to what I said earlier. If prices really drop, that's going to put huge pressure, not just on individual households, but potentially on the banking system as well.
Yes, absolutely. So we've already seen a lot of talk around the official US figures and whether or not they are in a recession, if that counts as in a recession. But now the UK is ticking down as well.
Well, so the UK declared that they were in a recession, and they basically said, look, it's going to be a shallow recession, but it's going to be a bit of a long recession, a couple of years. The UK have many of the similar issues that we've been speaking about. They've put rates up quite significantly. They've got very low productivity. They've got very low wages growth. There's lots of industrial action in the UK because people are struggling to try and get wages increased. And in fact, the nurses are going on strike. Trains have been on strike. I think even some of the transport sectors, other transport sectors are also, like shipping and things are also potentially going on strike. So there are lots of disruptions from there. But the issue is the UK is now in recession. So, first cab off the rank. I expect Europe to follow. I expect the US to follow. We are, I think, going to go through a recessionary journey, which sort of, as we'll see in a second, begs the question then as to why the markets are so strong if recession is coming.
Yeah, I definitely agree with that as well. Global yield curves inverting for the first time since back in the 2000, the dot-com bubble.
Yeah, this is amazing. This came out yesterday, and it's the first time that the long-term and short-term yields globally, not just in the US, but globally, have actually inverted. Now, an inverted yield curve like that says rates are going to be higher in the short term than longer because we think that longer term things are going to go off the boil and there might be a recession. Well, that's now not just in one country, but multiple countries are starting to see it. It's not true in Australia yet, but many other parts of the world are seeing these same recessionary signs. So chances are recession's coming. If recession is coming, then all bets are off in terms of what Reserve Bank and other central banks are going to do. As we said earlier, they'll have to change tack again, and that's why the chances of doing a bit more stimulus here and a bit more quantitative easing over there is still potential. So yes. It ain't over till it's over.
100%. Technology still under pressure, the NASDAQ?
Yeah, so I just thought I'd touch on this. So, of course, markets have had a run up, and sort of at the start of this year, they started to slide. They've been up and down a bit. They've come back up a little bit recently. That's partly because the yield curves have dropped a little bit, which means that the cost of future money is lower. That actually helps to the tech sector. But you can see the tech sector still well down from where it was. If you look at the main markets in the US, they've sort of come up quite a long way. So the question is this a bit of a temporary bounce before it falls again? And there are many people saying, if recession's there, earnings are going to be significantly reduced. That means we're going to probably see equities overvalued, and that means they could fall a lot further. Other people are saying, no. It'll be fine. From this, we've seen the bottom. Now, 2 points. First point, markets were saying China is coming out of the lockdown, whoopee-doo. That means that they're going to be actually able to support the economic momentum around the world, except, of course, maybe not. And the other was that, maybe the Fed is going to actually ease off on future rate rises because inflation's come down a little. And in fact, the latest data from the year showed that inflation was down a little, but actually, if you break it between services and products, product inflation was down a bit, services inflation was higher. And interestingly, the Fed is still saying we've got to lift rates a lot higher. So there is a very significant issue here that markets are over bullish. They're looking through the short term and looking long term. But I think we're going to see earnings damage over the next few months into the recession. That's going to put downward pressure on the market. So I wouldn't be surprised to see the markets continuing to fall as we go into next year.
Yeah, and I might even be a bit of a contrarian and I'll say all that matters is if there's any talk that the market can, they feel that the Fed is talking about any sort of pivot or slowdown. I just think even if earnings are bad and that, I think people are just waiting to flood back into the markets because if you price them in terms of the amount of money that's been printed, those new dollars and whatever, I think we need to start thinking about things, gold, crypto, stocks and whatever. There's just so much more money out there and less places to park than property. So I just think that this world is going to exist where all the fundamentals it shouldn't make sense why things are going up, but just the simple fact that they've printed so much money and it's going to go into these assets first, I think we can see bigger bubbles from what they're going to have to do next.
I agree that the huge asset bubble is because of the huge amount of quantitative easing and all of that liquidity that was created. We've never seen globally, we've never seen so much liquidity. That's got to go somewhere. And if in fact people say, I've got money, I've got to put it somewhere, they might well say, well, stocks not looking bad. Maybe they'll go back to bonds. I don't know. But the point is this, that if you go back to fundamentals that say, well, actually the stock market should have some equation to forward future earnings, the price earnings ratio, well, blow that out of the water and who knows?
Yes, yeah. It's a strange world we live in, Martin, but I think it could continue to get stranger.
I think we've got more strangeness to come yet. As I said, the uncertainty principle.
Yeah. The 2-year bonds higher in the US, up to four and a half.
I just wanted to highlight that if you look at it now, the 2 years at 4.48, the longer term, the 10-year is at 3.75, right? That degree of inversion is almost as extreme as it's been. So if you want a forward signal of recession ahead, that's there. An interesting Bloomberg surveys and modeling is 100% now locked into the idea of a recession in 2023. So there are many people in the US now saying recession's coming, we can't avoid it. And interestingly, of course, some of the central bank governors who now can talk again, having had their meeting, are saying a recession may be a necessary price to pay to get inflation under control. And they are worrying about the markets being too buoyant, and they need to see the markets come back, and they need to see wages not grow too strong, and they need to see unemployment rise. All those conditions they've discussed recently as being the necessary price to pay to get inflation under control. But as you and I have said, at some point, will they change their tune? And that's the key question.
Yeah, just to point out for people, it's only a year ago where you were barely getting a few basis points on your money sitting at a bank or in bonds,
Yep.
whereas you had all the reason in the world to go into risk assets, whereas now there's a lot of money that can just lock itself in and getting 4%, 5%. These are huge returns. If you're a big bank or a corporation, you're sitting on a lot of capital. Why would you look to spend it or invest in startups and those kind of risk assets? So,
Absolutely.
yeah, that's the price they're going to pay. And that's why I think they're slamming the brakes on the money, sucking liquidity out of these other sectors. So I do think we're going to see things slow down dramatically. While these rates stay high, investors can get that high relative yield to where it's been for so long.
Yeah, and just to underscore that, I recently rolled one of my term deposits. I got 4.95%. I mean, that's as risk-free as you can make it, right? I mean, okay, bail and what have you, but it's unlikely, and government guarantee, etc. But if you think about 4.95% as risk-free, then how much higher returns are you going to make to get a more risky proposition? And the answer is, in the current environment with risk ratios so high, it doesn't make a lot of sense. That's one of the reasons why investing is is limited from a corporate perspective.
Yep, absolutely. So the market's now lower than the Fed.
This is quite interesting, isn't it? Because their Fed dot plot is sort of their forward expectation. They don't do it that frequently, but the markets have now sort of been thinking, well, maybe 4.5 max. Some of the people out there are still saying the Fed will be at 5.5. So there's still upside. It's a question of how much, and is it going to go up? How high is it going to go up, and how long will it stay there? But there's an interesting now disconnect between what the Fed is saying and what the markets are saying. Up until recently, the markets were a lot higher than where the Fed was. It's turned. That might be a leading indicator of something.
Yeah, and I definitely agree with that. They're starting to price in rate cuts next year, which is kind of what I'm leaning towards as well.
Yep.
All right. US home prices slipping.
Yeah, and just this is from Wall Street. Great site. If people don't know it, go and have a look at it. But it's interesting that the first bubble was, you can see there, was quite big. The second housing bubble was massive. Prices are coming back now. And that's because higher interest rates, fixed mortgage rates are a lot higher than they were. The momentum in the housing sector and housing starts is also coming off. This is a very important thing to watch because, again, the Feds have said, house prices can afford to come back. We actually think they need to come down. That would be good. That would help inflation. So pretty much they're saying it doesn't matter whether it's home prices or whether it's other factors. we have to see these things easing back. So watch this space. I think we could be in for a very interesting ride if home prices drop further. At what point will they then turn turtle and say, oh, we can't allow that because of financial stability? We'll see.
Yes, and this is one of the worst cycles by far.
Yeah, this is quite interesting. Now, this is, of course, a bit artificial because the current one is sort of in the middle of it, so we don't know quite how it's going to end up. But if you look back over history, what happened to markets when the Fed's hiking cycles came through, you can see that quite often they actually end up, well, reasonably positive ultimately, whereas now we're at the most significant fall ever, right? That tells me something quite important in terms of, again, we were into a lot of uncertainty here. And the current story is that the markets are down significantly compared to where they would often be in a hiking cycle. Now, obviously, the Fed hiked significantly and fast. That's going to have a flow-on effect. But it does beg the question, is there more downside ahead, or are we going to see markets begin to turn the other way again, which goes back to my uncertainty. Nobody knows.
Yeah, and I think this kind of gives us some scope to talk about if they do pivot, then there possibly could be one of the sharpest V-shaped recoveries, depending on if they have to go those easing conditions.
Yep, that's right. Just print a bit more money and flood the markets again, and the markets will take off, and we'll see massive acceleration in stock markets. And there are people out there talking about a 20% increase next year of stock values. There are other people talking about a 50 or 60% fall in stock values, right? Both those futures, could be. Nobody knows which.
Yes. It all depends on their actions.
Yep.
So China's had some interesting policies lately with the lockdowns and talking about reopening, and now some changes for their banks.
Yeah, so it's very interesting. So they've done a whole bunch of measures to try and support the property sector, including more loans to some of the property developers. They've reduced their RRR, that's the required reserve ratio. In other words, the banks can lend more money without having to hold capital against it. So increase the risks on the banking system, but it puts more money into the system. And of course, we've had recently now the lockdowns as the virus continues to rage in China. We've had all the protests over the weekend, people standing up with blank pieces of paper like they did in Hong Kong in protest. The number of protests were quite significant, although they seem to be tailing off now. So those who argue that China is ready to march back and really increase its growth are being confronted by a whole bunch of realities. What is interesting is the amount of stimulus and support for the property sector that has been announced so far, about 16 measures so far. It's significant, but not dramatic. It's not going to be enough to sort of bring the property market back to where it was, because, of course, what they were concerned about there was the unsustainability of the property sector. So we're seeing some support, but anybody who thinks that this is going to be the green light for massive commodity improvements in terms of prices, I think are probably fooling themselves. And of course, the oil price is down a bit quite substantially because future demand is from China is probably less than expected, and China is one of the biggest importers of oil. So a lot to watch there.
Well, man, speaking of reserve requirements and that type of thing, we've touched on this before we talk about the banks and having these reserve requirements of around 10%, but we've seen in the crypto world, as soon as you've got more liabilities than assets and some of your collateral goes down, whatever, the contagion continues. And this was a true black swan event. FTX was the second biggest exchange in the world, used by myself and many others. Nobody could have seen this coming. And now we've got a further round of contagion in the wake of FTX bankruptcies.
Yeah, I mean, this is a very, sad story insofar that from just individual investors, a lot of investors put money into FTX thinking it was sort of a quasi-bank and that it was safe. And unfortunately, of course, as you know, if you don't hold the keys to your crypto, you don't hold the crypto. Now people are unfortunately finding the story out. But it's the contagion that's interesting, because if you go back to a crypto lender called BlockFi was actually bailed out by FTX earlier in the year because they got into difficulty. And now suddenly BlockFi is filing for bankruptcy because all of the stuff that they'd put on FTX's has gone. So they've got, and nobody quite knows just how much this contagion is going to be. I don't know whether you saw the Bloomberg chart that showed how FTX and Bankman-Fried's connections actually
subsidiaries, yeah.
Yeah, but a massive number of subsidiaries, all interconnected, all cross-leveraged. And, what's quite clear is that they were playing two sides to the middle, and they were then, basically leveraging the assets that were on the exchange and then, doing other things with them. Interestingly, the regulators in the US knew about this a few months ago and were asking hard questions, but didn't do much about it. Maybe that's because he was seen as, high-flying and had the right political nexus. I don't know. But I'm not sure anybody yet knows what the limits of the contagion here will be and what the implications are. What I would say is that many people will now be questioning, crypto in its entirety. But of course, you've got to be careful because you can't blog everything in one lump and say that means that Bitcoin and crypto are all sort of in the same boat. Maybe not. I think there are some differences there, but a lot of these derivative-led leveraged investments where a lot of people being promised huge returns are now shown to be a sham. And of course, it's completely unregulated. Even in Australia, the regulation, caught people out with FTX Australia, 30,000 customers probably with losses there. And unfortunately, of course, it's got all now stories in the papers and on ABC, somebody putting their superannuation into a crypto and then losing it all.
Yeah.
This is a really, really sad story. And I guess there's a couple of observations. One is nobody knows quite how far the bounds are going to be. But a lot of this stuff, this cross-leveraging and everything else, this is precisely the way that it played out through the global financial crisis as well. Yeah. And a lot of the same philosophy, and actually even some of the same players, are actually doing precisely the same. This is, to me, corporate greed. This is actually people profiting on this. And the key point is, that if you stand by the idea that Bitcoin is the decentralized, devolved, no central control, you own your own bit of it, you have a cold wallet. This is a billion miles from this end of crypto land, isn't it?
Oh, 100%. It's these centralized players and the centralized actors, and everything in DeFi has been working properly. People get liquidated at the certain prices and there's no double lending or anything. It's all on the blockchain. So I think it's important, as you say, to separate that this wasn't Bitcoin or Ethereum. This is the centralized exchanges and the same concepts that are still going on in the traditional financial system in the world of trillions of derivatives and who owns what. That's all still the same game there. But some of the stuff that has come out, we've got a thread in our research group about all these connections, as you say, links to Ukraine, links to the different political parties, and there hasn't really been any repercussions yet. The CEO's still doing interviews and so on, and some of the wild stuff that's happening in the Bahamas. And I think there's already been a couple of people come out to make movies and documentaries about this, because it is probably the wildest story since Lehman Brothers or Enron or whatnot. So yeah, more details to come out. I think, as you said, it's just a big mark on the crypto industry. But at the same time, I think that I haven't seen sentiment this bad, with everyone saying, oh, this is horrible, this is as bad as it gets. So possibly that can sometimes mark a bottom for markets. But yeah, it's not good.
No, and just remember that we had 3 trillion in crypto at the best. It's now about 800 billion.
Yeah,
a huge fall. And of course, there's no guarantee that things are going to fall further. In fact, even people are saying, well, maybe even Bitcoin could go to 12,000 US or something. I don't know. I mean, the point is, an object lesson, it's not regulated. Most people who got into it didn't understand what they were getting into, and basically, I think, were sold the dream, the vision. And there's this thing called multi-level marketing, which it's really important for people to understand, because the people who are on the ground floor, might do quite well if they can persuade other people to buy stuff, and then they persuade other people to buy stuff. But as you come in later, you're basically hoping that you can find other people, maybe the greater fool, to continue the same story. This is a really worrying aspect of this whole thing, because it means that nobody knows what the true value of anything is. And this goes right back to the global financial crisis and right back to those fundamental issues. And so I think caution is important, but don't throw a baby out with bathwater, right? That doesn't mean necessarily that the idea of having a decentralized, devolved, immutable entity on the blockchain is necessarily dead. It just means it may actually be morphed. And maybe if we clear away some of the rubble and also get an appropriate degree of regulation in on this, that will probably be a good thing. But I'm afraid that a lot of people have lost confidence and lost their shirts.
Absolutely. And it's been another period of, as you say, washing out of those high yield things that weren't sustainable. And now that you can get 5% on a US government bond, like off the crypto yields themselves are even less attractive, and it's all relative. So I guess it's a learning lesson for the crypto investors that haven't thought about these things in terms of relative yields before. But like all bear markets, a big washout at the moment. But fantastic episode, Martin. Always great chatting. And we'll have to do it again next month.
I'll just make one thing. I want to just highlight the fact that branches are being closed in regional areas across Australia. And I'm in the middle of a campaign to try and stop it, because basically we know that regional communities need branches and need branch banking. I'm working with, for example, Cooper Pedy, which is 500 miles from the local branch down the road once Westpac shuts. It's really important that people think about this, because we are not all digital and we can't do everything digitally. So if people want to find out more about regional bank closures and what we're doing about it, go across to my site and see some of the recent shows that I made, because there's a really big story here. We've got political parties starting to get active and involved. We've had statements in the Senate, and I've put a request into the Senate for an inquiry specifically on this. This is a big deal.
Yeah, a great cause to get behind, and I'll support that as well, Martin. So thanks everyone for your time, and we'll see you again next month. Cheers.
Cheers.